Welcome to TheoTrade. This is Don Kaufman. Here we are. It's January 9th, 2017. I want to kick off this evening's Theo Night video with what continues to be a wild, again, kind of bifurcation of the major index products. You know, I've been talking a lot to other traders in the industry. These are some people I know at some arbitrage firms, a couple of guys over to Vol Arb firms specifically. And we've been discussing this well, again, what you're looking on your screen right now. So this is something I've been talking about extensively lately. If you're not really in the know, I'm going to bring you up to speed really quick over here. On top, what you're looking at right now happens to be the Qs, right? Which is the Nasdaq. Right over here in the middle happens to be the spiders, the S&P, and last but not least, to the bottom of your screen happens to be none other than the IWM. Now, the chart that we're bringing up happens to be on a 10-day hourly at this point, so just a 10-day hourly. And what you're seeing over here, again, seeing is kind of believing, based on the last 10 days, the products themselves are completely diverging from one another, where you're getting the Nasdaq up and the IWM down. So if you're looking at this and you're thinking you're missing out because you're like, oh, the Nasdaq, it's breaching new highs every single day, okay? All right, so you got the Nasdaq breaching into new highs every single day. You kind of feel like you're missing the boat. The spiders are just off all-time highs, but the IWM is falling. This is nothing more than asset managers and rolling allocations. That is, capital is rolling, okay, from one product out into another. Now I'm showing you this on a much broader notion. That is, I'm showing you, okay, out of the IWM into the Nasdaq over there. And it's really specific to handfuls of products. Now, again, it's highly unusual to see this wide of a gap, this much of a divergence in such a short window of time. Again, this is just the last 10 days. So, you know, another trader knows that I look at this stuff a lot, correlations and coefficients. And he asked me, he said, you know, have you ever seen anything like this? Like, traders love to compare stuff against other traders. So they call me up, hey, have you ever seen anything like this? And I said, you know, the only time that I can remember seeing a faster or larger divergence, okay, than this, and I actually had to go back in time and I'll show it to you. Okay, so here we go into the live markets right now. So I'm going to close up that left side bar. And if you take a look, now all you're looking at over here, okay, I'll highlight this for you. This is the Qs versus the spiders. And if you start to look at specific, these are perfectly aligned. Okay, they're perfectly aligned. Look at specifics and you're going to see days where the spiders are rocketing to the upside and the Nasdaq is a little bit weak. Then all of a sudden you see the Nasdaq falling out of bed, okay, and the S&P is actually rallying and substantially rallying on a couple of those days. All right, here's a wild trading day. So yeah, I have seen this before. This is all the way back, okay, in March of 2000. This is a 20-year daily chart that I had to pull to find such wild divergences in the marketplace. And I thought I would kick off the Theo Night video with something fun from that time frame. Now, if you're going to ask me specifically here, what do you think about this right now? Okay, you have to recognize a few things about today's marketplace. Obviously, I'm not comparing this per se to the rise and fall of the Nasdaq. However, it is uncanny right now. The Nasdaq is exploding to the upside, ultimately at the direct cost of both the Russell and the S&Ps. This is just classical asset rotation. That is, capital out of one class into another class. In this case, you don't even have to look at the individual sectors. You don't have to go to sector rotation. No, this is just major asset classes. This is, the Nasdaq versus the S&Ps versus the Russell. Okay, so here's the Nasdaq ripping up to new highs. Now, one thing that I'm a little bit untrusting of, though, in this particular marketplace, and this is what's making me kind of uneasy. Look at the S&Ps today, and we still have just over 15 minutes left in the trading day, people, we're only going to do maybe 1 million S&P contracts all day. Now, for those of you that don't necessarily look at markets all day, every day, you're like, oh, okay, so 1 million S&P contracts. We're not in a holiday trade, okay? You can't find a chart where we traded this low of volume and we're not in a holiday trading session, meaning that there isn't any volume to compare that is as low as we're seeing right now. Like people, listen, I can go back for 3 years, and every time you see volume dropping this low, it had something to do with a holiday. There is zero conviction to trade right now. None whatsoever. Okay. Moreover, if you start looking at the volatilities over here, okay, they are alarmingly low. You know, if there's sirens off for like low volatility, well, guess what? They should sound the alarm right now because you're sitting at an 11.5 VIX. Now, just because volatility is incredibly low doesn't necessarily mean, okay, that markets all of a sudden are going to turn around and tank. But when you start looking at volatility in the SPX, now I want to be very, very clear about this because and highlight it. You look at volatility in the SPX. Here's the SPX product is trading at 2,271, okay? And you start to go out in time a little bit, all right? So let's go out here, January 20th, okay? All right, we have an inauguration coming up. After the inauguration, we might see some major changes in policy almost overnight. Well, those changes in policy must already be priced into this marketplace. I'm saying that, though, facetiously, because there's no volatility anywhere to be seen. This is 50 days out, and we're still sitting at a 12.27 vol. That's the equivalency of the VIX 50 days out being at 12. There's nothing, okay? I caution you. Is this a bullish sign? Absolutely not, okay? Where do the markets have to go? We're now seeing signs of asset rotation. Again, when you talk about this asset rotation, so we're coming out of the S&Ps, out of the Russell, in specifically to the Nasdaq, you know, think of that as a game at this point with asset managers. It's a game of musical chairs, okay? Where they're like, we're not happy over here, let's roll over here. This is not good, let's roll over here. You know, that works until the music ultimately stops out there. On another front, okay, we are coming in to earnings. Earnings don't necessarily have the propensity to rock markets out there, but looking at these volatilities, it's dismal. At a 10% implied volatility, it's very difficult at this time as a trader to be objective. And I always try to come in here, you know, with the Theo Night videos, be as objective as possible and paint a picture to you. But first of all, you're looking at this, and again, markets, okay, approaching all-time highs. You're seeing asset classes, you know, being rotated out of. Apparently, the only stocks worth buying today are Facebook, Apple, Google, and maybe a little bit of Amazon. And there's not exactly any conviction to per se to any of those over here. It's hard at this point to want to be able to make a bullish case with volatility so low. Moreover, as a trader, I'm always looking for fair and two-sided trade. And that ultimately means, hey, listen, we've seen a one-way ticket to the upside over here since what? Okay, late October. You know, you can point out on one hand the number of down days that we've had since late October. At this point, you know, hey, clock's ticking on terms of the SPX and volatility taking off. Look to take long volatility positions. I just keep reiterating that. Now, on another note over here, if you look at the SPX volatility, and the SPX volatility is like 10%, compare that to the spiders, it's going to be right in line, right? So the spiders are just the mini version of the SPX. Volatility is all about 10%. However, one product is starting to actually see a bump up in terms of implied volatility. Take a look at the IWM, the Russell. What is the Russell seeing that the rest of us haven't really come to fruition yet, all right? I mean, the Russell, its volatilities, historically speaking, are higher than the S&Ps, but its volatilities here 39 days out, okay? That stands out to me. That thing's almost 20%. You realize that it's actually tracking substantially substantially higher volatility. Again, let's look at the 39-day options in the IWM, which are 18.5 vol, and compare those to the spiders. We'll go 39 days out in the spiders. Spiders happen to be what? About a 12% implied volatility. So you're seeing, well over a 30% increase in implied volatility from one index product to another. Clearly, right now, the Russell is seeing risk. Therefore, if you're not catching what I'm trying to throw at you over here, one of the trades that you could absolutely consider, even though the Russell is already had about 3 down days, you could consider a more bearish position inside of the Russell, being it was the single most overbought product in the recent rally. Well, at least I'll tell you what, that's where my money happens to be. So I'm in a number of Russell positions right now. I am short the Russell, not just in the IWM. I'm also using Russell futures out there. So I happen to be short right now and carrying positions in Russell futures. If you're not familiar with Russell futures, that's fine. Listen, futures markets can be a little bit difficult. Tactically speaking, it's probably easier to use spreads inside of the IWM. I'm using a combination thereof. And again, I am carrying a multitude of positions, one of them being inside of the Russell futures itself. And you can actually see, again, I'm short 3 Russell futures. In addition to it, I've actually got some put spreads that I've purchased on, the February contracts out here. This is February 3rd. It's 25 days out. This contract is already in the money over here. Nevertheless, the IWM seems to be where the volatility's at. Last but not least, watch banks. They have earnings coming up this Friday. So just keep in the back of your mind, could see some volatility inside of the XLF coming towards the latter portion of the week, given the fact that, again, many of your large banks are going to be releasing earnings prior to the cash open on Friday morning. Thanks, everybody, for joining us here at TheoTrade. I'm Don Kaufman. Be in the TheoTrade chat room all throughout the course of this week. Have a great evening. Bye-bye.